And so we'll start off in Chapter 1 with financial statements. Financial statements provide us with the ability to measure business activities. They provide us with the data that is then consolidated into reports that become information, and this allows us to communicate results through the generation of financial statements. The better you understand these financial statements, the better use they are to you in making the economic financial decisions we recently talked about. The financial statements measure performance and communicate where a business stands in financial terms, and we'll cover a great many of those terms in this course. So we talked earlier about the users of accounting information and that these could be external stakeholders or internal stakeholders. Let's explore that a little more. So individuals consist of people who manage their personal bank accounts, decide whether to rent an apartment or buy a house, budget monthly income and expenditures of their businesses, and accounting provides the necessary information to allow these individuals to make these decisions. When we talk about investors and creditors, we're talking about users who provide the money to finance businesses. Investors want to know how much income they can expect to earn on an investment. Creditors want to know when and how a company is going to pay them back. These decisions also require accounting information. All kinds of regulatory bodies use accounting information. For example, the Internal Revenue Service and various state and local governments require businesses, individuals, and other types of organizations to pay income tax, excise, and other taxes. Another regulatory body, the United States Securities and Exchange Commission, requires companies whose stock is traded publicly to provide it with many kinds of periodic financial reports. All of these reports contain financial information. And then finally, we talk about nonprofit agencies such as churches, hospitals, and charities. They base many of their operating decisions on accounting data as well. In addition, these organizations have to file periodic reports of their activities with the IRS and state governments, even though they owe no taxes. So we can see that the accounting information touches a lot of users, and a lot of users depend on that accounting information and the accuracy of it in order to make economic decisions. And we'll talk later, too, about the role that auditing plays with respect to these financial statements. So let's talk now about the different kinds of accounting. Both external and internal users of accounting information exist. We can therefore classify accounting into two branches. Financial accounting provides information for decision makers outside the entity, such as investors or creditors, government agencies, and the public. This information must be relevant for the needs of decision makers and must faithfully give an accurate picture of the entity's economic activities. Management accounting, on the other hand, provides information for managers of a business. And so that's used, managerial accounting produces reports that are generally used more for internal management purposes. And examples of these reports include budgets, forecasts, and projections that are used in making strategic decisions of the entity. Internal information must still be accurate and relevant for the decision needs of managers. When we talk about the different types of businesses, we are talking about generally one of these four types, either a proprietorship, a partnership, a limited liability company, or a corporation. And each of these types have advantages and disadvantages. So let's explore each of these a little bit further. A proprietorship has a single owner called the proprietor. Proprietorships tend to be small retail stores or solo providers of professional services such as physicians, attorneys, or accountants. Legally, the business is the proprietor, and the proprietor is personally responsible or liable for all of the debts. But for accounting purposes, a proprietorship is considered a distinct entity separate from its proprietors. Thus, the business records should not include the proprietor's personal finances. And what that means is that when we're reporting on the results of operations, we should be reporting on the results of the operation of the proprietorship, and we should not be commingling the proprietor's personal assets and the results of their investments, the results of their financial decisions with respect to personal issues, with the results of the proprietorship or the organization we're reporting on. Partnerships are another form of entity, And a partnership has two or more parties as co-owners, with each owner as a partner. Individuals, corporations, partnerships, or other types of entities can be partners. And so we can have a partnership made up of individual partners or corporations who are each partners. Income and loss of the partnership flows through to the partners, and they recognize it based on their agreed upon percentage interest in the business. The partnership is not a tax-paying entity. Instead, each partner takes a proportionate share of the entity's taxable income and pays tax according to that partner's individual or corporate rate. Partnerships are governed by the agreement, usually spelled out in writing in the form of a contract between the partners. General partnerships have mutual agency and unlimited liability. What that means is that each partner may conduct business in the name of the entity and can make agreements that legally bind all partners without limit for the partnership's debt. Partnerships are therefore quite risky because an irresponsible partner can create large debts for the other general partners without their knowledge or permission. This feature of general partnerships has spawned the creation of what's called limited liability partnerships. These limited liability partnerships, or LLPs, are one in which a wayward partner cannot create a large liability for the other partners. In LLPs, each partner is liable for partnership debts only up to the extent of his or her investment in the partnership, plus his or her own proportionate share of the liabilities. Each LLP must have one general partner with unlimited liability for all partnership debts. So we distinguish an LLP from an LLC, or a limited liability company. An LLC is one in which the business and not the owner is liable for the company's debts. An LLC may have one owner or many owners called members. Unlike a partnership or a general partnership, the members of an LLC do not have unlimited liability for the LLC's debts. An LLC pays no business income tax. Instead, the LLC's income flows through to the members, and they pay income tax at their own tax rates, just as if they would if they were partners. Today, many multiple owner businesses are organized as LLCs because members of an LLC effectively enjoy limited liability while still being taxed like members of a partnership. A corporation is a business entity owned by the stockholders or shareholders who own stock representing shares of ownership in the corporation. One of the major advantages of doing business in the corporate form is the ability to raise large sums of capital from issuance of stock to the public. All types of entities, individuals, partnerships, corporations, or other types, may be shareholders in a corporation. Even though partnerships and proprietorships are more numerous, corporations conduct much more business and are larger in terms of assets, income, and number of employees. A corporation is formed under state law. Unlike proprietorships and partnerships, a corporation is legally distinct from its owner. The corporation is like an artificial person and possesses many of the same rights that a person has. However, unlike partnerships or LLCs, a corporation pays a business income tax as well as many other types of taxes. Furthermore, the shareholders of the corporation are effectively taxed twice on distributions received from the corporation, called dividends. Thus, one of the major disadvantages of the corporate form of business is double taxation of distributed profits. Ultimate control of a corporation rests with the stockholders, who generally get one vote for each share of stock they own. Stockholders elect the board of directors, which sets policy and appoints officers. The board elects a chairperson who holds the most power in the corporation and often carries the title Chief Executive Officer. The board of directors also appoints the president as Chief Operating Officer. Corporations also have various vice presidents in charge of sales, accounting, and finance, and other key areas. So now let's explain and apply underlying accounting concepts, assumptions, and principles. So accountants follow professional guidelines for measurement and disclosure of financial information. These are called Generally Accepted Accounting Principles, or GAAP. In the United States, the Financial Accounting Standards Board formulates GAAP. The International Accounting Standards Board sets global or international financial reporting standards. A joint conceptual framework was developed by FASB, or the Financial Accounting Standards Board, and the IASB, or International Accounting Standards Board, to address the following: the objective of accounting, its fundamental qualitative characteristics, those qualitative characteristics that enhance accounting information, and its constraints. And this is a rather complicated diagram, but it gives an overview of the joint conceptual framework of accounting developed by the FASB and the IASB. Financial reporting standards at the bottom follow the conceptual framework. The overall objective of accounting is to provide information, and that's financial information, about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions. To be useful, information must have the fundamental qualitative characteristics, which include relevance and faithful representation. To be relevant, information must be capable of making a difference to the decision maker, having predictive or confirming value. In addition, the information must be material, which means it must be important enough to the informed user so that if it were omitted or erroneous, it would make a difference in the user's decision. To faithfully represent, the information must be complete, neutral or free from bias, and without material error or correct. Accounting information must focus on the economic substance of the transaction, the event, or the circumstance, which may or may not always be the same as its legal form. Faithful representation makes the information reliable to users. Accounting information also must have a number of enhancing qualitative characteristics, which include comparability, verifiability, timeliness, and understandability. Comparability means that the accounting information for a company must be prepared in such a way as to be capable of being both compared with information from other companies in the same period and consistent with similar information for that company in previous periods. Verifiability means that the information must be capable of being checked for accuracy, completeness, and reliability. The process of verifying information is often done by internal as well as external auditors. Verifiability enhances the reliability of information and thus makes the information more representative of economic reality. Timeliness means that the information must be made available to users early enough to help them make decisions, thus making the information more relevant to their needs. Understandability means that the information must be sufficiently transparent so that it makes sense to reasonably informed users of the information. Those, again, are users such as investors, creditors, regulatory agencies, and managers. Accounting information is costly to produce. A primary constraint in the decision to disclose accounting information is that the cost of disclosure should not exceed the expected benefits to users. Management of an entity is primarily responsible for preparing accounting information. Managers must exercise judgment in determining whether the information is necessary for complete understanding of underlying economic facts and not excessively costly to provide. Next, we'll talk about the assumptions and principles that are inherent in accounting. The entity assumption is the most basic accounting assumption, and that's that any organization that stands apart as a separate economic entity. Sharp boundaries are drawn around each entity so as not to confuse its affairs with those of others. So, for instance, we talk about a proprietorship. Well, the company that a proprietorship has formed becomes the entity, even though the assets of that organization or company may be commingled with the assets of the owner, the liabilities may be commingled, there may be a lot of related party transactions, but as in accounting for the transactions and the economic events of a proprietorship, we want to break apart the transactions and the results of operations of the proprietorship from those of the proprietor. And that's an example of this entity assumption. So in measuring and reporting accounting information, we assume that the entity will continue to operate long enough to use existing assets, that is, land, building, equipment, and supplies, for its intended purpose. This is called the continuity or going concern assumption. The historical cost principle states that assets should be recorded at their actual cost, measured on the date of purchase as the amount of cash paid plus the dollar value of all non-cash consideration, that is, other cash privileges or rights, given in exchange for the asset. The historical cost principle is not used as pervasively in the U.S. as it once was. Accounting is moving in the direction of reporting more and more assets and liabilities at their fair values. Fair value is the amount that the business could sell the asset for, or the amount that the business could pay to settle the liability. And then finally, under the stable monetary unit assumption, accountants assume that the dollar's purchasing power is stable over time. Until recently, one of the major challenges of conducting global business has been the fact that different countries have adopted different accounting standards for business transactions. Historically, the major developed countries in the world have all had their own versions of GAAP. As investors seek to compare financial results across entities from different countries, they've had to restate and convert accounting data from one country to the next in order to make them comparable. This takes time and, as you can imagine, can be very expensive. The solution to this problem lies with the International Accounting Standards Board, which has developed International Financial Reporting Standards, or as they are referred to as IFRS. These standards are now being used by most countries around the world. For years, accountants in the United States did not pay much attention to IFRS because our GAAP was considered to be the strongest single set of accounting standards in the world. In addition, the application of GAAP for public companies in the United States is overseen carefully by the U.S. Securities and Exchange Commission, a body which at present has no global counterpart. Nevertheless, in order to promote consistency in global financial reporting, the SEC has announced a plan to require all U.S. companies to adopt some version of IFRS. U.S. adoption of IFRS is tentatively scheduled in stages, beginning with the largest companies starting in approximately 2015. The advantages to adopting a uniform set of high-quality global accounting standards is that financial statements from a U.S. company will be comparable to those of a foreign company. Using these standards, it will be easier for investors and business people to evaluate information of various companies in the same industries from across the globe, and companies will only have to prepare one set of financial statements instead of multiple versions. Thus, in the long run, a uniform set of high-quality global accounting standards should significantly reduce costs of doing business globally. These are impressive goals, but what do these changes mean for the U.S. GAAP? It could mean that U.S. GAAP will be replaced by the international standards within the next decade. More likely, it will mean that U.S. GAAP will continue to exist and become a domestic interpretation of IFRS for companies that are based in the United States. So, does this mean that the accounting information you're studying in this textbook will soon become outdated? No. For one thing, the vast majority of introductory material you learn from this text and this course, including the underlying conceptual framework outlined in the previous section, is already part of IFRS as well. The most commonly used accounting practices are essentially the same under U.S. GAAP and IFRS. Additionally, the FASB is working hand in hand with the IASB toward convergence of standards, or that is gradually adjusting both parts of standards to more closely align them over time so that when transition to IFRS in the United States occurs, it will occur smoothly. Over the past few years, all newly issued U.S. accounting standards have conformed U.S. practices to IFRS. So the next topic we want to talk about is what we call the accounting equation and what that means to business organizations. A company's financial statements tell us how the business is performing and where it stands. But how do we arrive at the financial statements? Let's examine the elements of financial statements, which are the building blocks on which these statements rest. The financial statements are based on the accounting equation. This equation presents the resources of a company and the claims to those resources. When we talk about assets, we are talking about economic resources that are expected to produce a benefit in the future. Generally, we're talking about resources that are expected to convert to cash within the next operating cycle, and generally the next operating cycle means the next year. Claims on assets, on the other hand, come from two sources. Liabilities, which are outsider claims, they are debts that are payable to outsiders called creditors, or owner's equity, also called capital or stockholders' equity for a corporation. And these represent insider claims of a business. Equity meaning ownership. The accounting equation shows the relationship among assets, liabilities, and owner's equity. Assets appear on the left side, and liabilities and owner equity on the right side. And as you can see in the equation, these two sides must equal. So assets equal liability plus owner's equity. Examples of assets include cash and cash equivalents, which are the liquid assets that are the medium of exchange. They may also include merchandise, inventory, or products held for sale, or property, plant, and equipment or fixed assets, such as long-lived assets that the company uses to do business, like stores, equipment, buildings, computers, and so on. Liabilities, on the other hand, include a number of payables, such as accounts payable and federal and state income taxes payable. The word payable always signifies a liability. An accounts payable is a liability for goods or services purchased on credit and supported by the credit standing of the purchaser. Long-term debt is a liability supported by the credit standing of the holder of the debt. So the current portion of long-term debt is the amount due within the next year, and it has to be disclosed separately. And we'll talk about the difference between current assets and non-current assets and current liabilities and non-current liabilities a little later in the course. Owner's equity of any business is its assets minus its liability. We can write the accounting equation to show that owner's equity is what's left over after we subtract liabilities from assets. A corporation's equity, called stockholders' equity, has two main parts, paid-in capital or retained earnings. And essentially what we're saying with owner's equity is that after we paid off all of the liabilities of the company and liquidated or sold all of the assets, whatever's left over becomes that of the owners. The accounting equation can be written as assets equals liabilities plus stockholders' equity, or assets equal liabilities plus paid-in capital plus retained earnings. Paid-in capital is the amount the stockholders have invested in the corporation. The basic component of paid-in capital is common stock, which is the corporation issues to the stockholders of evidence of their ownership. All corporations have common stock. Retained earnings is the amount by income-producing activities and kept for use in the business. Three major types of transactions affect retained earnings: revenues, expenses, and dividends. Revenues are inflows of resources that increase retained earnings by delivering goods or services to the customers. So revenue is what's generated by our sales of products or sales of service. They generate revenue. Expenses are resource outflows that decrease retained earnings due to operations. For example, the wages that a company pays employees are an expense and they decrease retained earnings. Expenses represent the cost of doing business. They are the opposite of revenues. Expenses include costs of goods sold, building rent, salaries, and utility payments. Expenses also include the depreciation of display cases, racks, shelving, other equipment, or property and plant. Dividends also reduce or decrease retained earnings because they are distributions to stockholders of assets, usually cash, that are generated by net income. A successful business may pay dividends to shareholders as a return on their investments. Dividends are not expenses. Dividends never affect net income. Instead of being subtracted from revenues to compute net income, dividends are recorded as direct reductions of retained earnings. And what we're saying there is that in order to get to net income, I start with my revenue and I deduct a series of expenses. Those may be cost of goods sold expenses, they may be general and administrative or overhead expenses, and then I come down to an earnings before tax. I then calculate my tax based on the taxable amount of my taxable income to get net income. After that, what I do with that net income and whether I decide to reinvest it in the company or decide to distribute a portion of it as dividends to the shareholders. So to review, revenues increase retained earnings while expenses and dividends decrease retained earnings. Businesses strive for profits, the excess of revenues over expenses. When total revenues exceed total expenses, the result is called net income, net earnings, or net profit. Obviously, when expenses exceed revenues, the result is a net loss. Net income or net loss is the bottom line on an income statement. This slide shows the relationship among the following: retained earnings, revenues minus expenses equal net income or net loss, and dividends. And so next we want to talk about how we evaluate business opportunities and operations through the use of these financial statements. The financial statements present a company to the public in financial terms. Each financial statement relates to a specific date or time period. So what would investors want to know about a company at the end of its fiscal year? This table lists 4 questions that decision makers may ask. Each question comes from one of the key financial statements. So we can see from the income statement, an investor may ask, well, how well did the company perform during the year? And the answer to that would include some assessment of revenues minus expenses to get to our net income or loss. Additionally, an investor may want to know, well, what is the company's financial position at year-end? Does it have a strong financial position or a weak financial position? And this we would answer by reviewing the balance sheet, which we've said before is viewed from an equation, or the accounting equation, of assets equal liabilities plus owner's equity. And then we have the statement of retained earnings, and we have the statement of cash flows. And each of these are key statements that all major corporations have to issue at least at the end of each year, and often they're issued quarterly to the SEC, which we spoke about earlier, and they have to be audited by accounting firms and auditors. So the following diagram shows how the data flow from one financial statement to the next. Right. The income statement or statement of operations reports revenue and expenses for the period. The bottom line is net income or net loss for the period. In accounting, the word net refers to the amount after a subtraction. So net income is the profit left over after subtracting expenses and losses from revenues and gains, including taxes. Net income is the single most important item in the financial statements. So this gives us an example of an income statement. This company has 2 types of revenue: net sales and other revenues. Revenues do not always carry the term revenue in their titles. For example, net sales revenue is often abbreviated as net sales. Net sales means sales revenue after subtracting all the customer's goods that have been returned to the company. Not all expenses have the word expense in their title. For example, many retailers use the cost of goods sold title in their financial statement lines. Another title of this expense is cost of sales. This expense represents the direct cost of making sales, and it includes the cost of the merchandise sold to the customers. Selling, general, and administrative expenses are the costs of everyday operations that are not directly related to merchandising purchases. Many expenses may be included in this category, including sales commissions paid to employees, catalog production, mailing costs, warehousing expenses, depreciation, credit card fees, executive salaries such as the president's salary, and other office expenses. Interest expense is the cost of borrowing money. Companies are allowed to offset items like interest expense and interest income against each other and show only the difference. Income tax expense is the expense levied on the corporate income by the government as a percentage of income earned. This is often one of the corporation's largest expenses. And as you continue to work in accounting, you'll see that there are multiple different versions or formats that an income statement, and a balance sheet for that matter, can be presented in. The statement of retained earnings means exactly what that term implies. That portion of net income the company has kept over a period of years. So it's retained earnings. If historically revenue exceeds expenses, the result will be a positive balance in retained earnings. On the other hand, if historically expenses have exceeded sales revenue and the company has suffered losses, the accumulation of these losses will result in accumulated deficit in retained earnings. Net income or net loss flows from the income statement to the statement of retained income or retained earnings. Net income increases retained earnings, and net losses and dividends decrease retained earnings. This shows us a typical statement of retained earnings, and it reflects the activity in the account. As we can see, we start with a beginning balance of retained earnings. We add to it net income. If this had been a net loss, it would have been less net loss. And then we reduce retained earnings for any dividends also declared by the board of directors and paid to shareholders. The result of all of this is the current year retained earnings balance. A company's balance sheet, also called the Statement of Financial Position, reports 3 items, and we've talked about those. They include assets, liabilities, and stockholders' equity. There are 2 main categories of assets, current and long-term or non-current. Current assets are assets that are expected to be converted to cash, sold, or consumed during the next 12 months or within the business's operating cycle if longer than a year. Current assets include cash and cash equivalents, short-term investments, accounts receivable and notes receivable, merchandise inventory, and prepaid expenses. All companies have cash. Cash is the liquid asset that's the medium of exchange, and cash equivalents include money market accounts or other financial instruments that are easily convertible to cash. Short-term investments include stocks and bonds of other companies that the company intends to sell within the next year. Accounts receivable are amounts the company expects to collect from customers. Notes receivable are the amounts a company expects to collect from a party who has signed a promissory note to the company and therefore owes it money. Merchandise inventory is a retailer's most important and probably the largest current asset. Prepaid expenses represent amounts paid in advance for advertisements, rent, insurance, and supplies. Prepaid expenses are current assets because the company will benefit from these expenditures in the next fiscal year. The main categories of long-term assets are property and equipment, also called plant assets, and intangibles such as goodwill. Long-term assets may also include other investments that are expected to benefit the company for long periods of time. Property and equipment includes land, building, computers, store fixtures, and equipment. Intangibles there are assets with no physical form, such as patents, trademarks, and goodwill. Long-term investments are those investments the company does not intend to sell within the next year. Other assets is a catch-all category for assets that are difficult to classify. And so, when we talk about liabilities, we can talk that these are also divided into current and long-term or non-current categories. Current liabilities are debts that are payable within 1 year or within an operating cycle if longer than a year. Chief among current liabilities are current maturities of long-term debt, accounts payable, accrued expenses, federal income and state taxes payable, and other liabilities like short-term notes payable. Long-term liabilities, similar to non-current or long-term assets, are payable after 1 year. And then we get to the final section of the balance sheet, and that's the stockholders' equity section. So the assets or the resources of the organization and the liabilities or the debts of the company are fairly easy to understand. Owner's equity is a little harder to pin down. It's simple to calculate, but what does it mean? A corporation calls its owner's equity stockholders' equity, and this title is descriptive. Remember that a company's owner's equity represents the stockholders' ownership of the business assets. A common corporation's equity consists of common stock, which are shares issued to the stockholders. This balance represents the face amount or par value of the stock. Par value is an artificial amount set by the company for the stock. We'll also include additional paid-in capital, which represents amounts of cash received on the initial sale of the company's stock in excess of the par value. So suppose the company is issuing stock with a par value of $10 a share, but when they sell it on the market, they receive $15 a share. The additional $5 per share will be recorded to an additional paid-in capital account, while the $10 per share will be recorded to the common stock account. We talked about retained earnings, and that's the amount earned by income-producing activities and kept for use in the business. And it's reduced by, as we said earlier, dividends paid. Then treasury stock represent amounts paid by the company to repurchase its own stock, and this is done for a variety of reasons that we'll talk about later on. Accumulated and other comprehensive income or loss represents items of gain or loss that are allowed by the FASB to bypass the income statement and be recorded directly into stockholders' equity. And this could happen because they are extraordinary items that we wouldn't want to include on the income statement because it would distort, for comparability purposes, the results of this year's activities. This is an example of a template for a corporate balance sheet. Each classification in the assets and liabilities is subtotaled, and then the subtotals are combined to result in the total for the section. So you see we have a total current assets, a total other assets, and which are the non-current or long-term assets, and we get the total assets. We have total current liabilities. We have then we total that with the long-term or non-current liabilities to get the total liabilities. Then we have our total stockholders' equity section. We add stockholders' equity to total liabilities to get the total liabilities and stockholders' equity section, which must, according to our accounting equation, equal total assets. The third financial statement that we talk about is the statement of cash flows. And I'm sorry, this is the fourth financial statement. And it measures cash receipts and cash payments. And essentially what it tells the investor is, how did we generate cash and how did we use cash over the last period? And to that end, then, we categorize these sources and uses of cash into three types of activities. That is operating, investing, and financing. And we'll talk about the types of transactions that would be illustrative within each of those categories later on. Operating activities comprise the activities that a company does by selling goods and services to customers. Operating activities result in net income or net loss, and they either increase or decrease cash. The income statement tells whether the company is profitable. The statement of cash flows reports whether operations increase by the company's cash balance. Operating activities are most important, and they should be the company's main source of cash. Continuing negative cash flows from operations can lead to bankruptcy. And we've seen cases where a company can be profitable, but because of cash flow, are forced out of business. Investing, on the other hand, comprises those activities including the buying and selling of fixtures and equipment. When these assets wears out, the company has to sell them. Both purchases and sales of long-term assets are investing cash flows. Investing cash flows are the next most important after operations. And then finally, we get to financing activities. Companies need money for financing. Financing includes issuing stock, paying dividends, borrowing, and repayments of borrowed funds. The company also pays loans and repurchases its own stock. So our next learning objective is to construct these financial statements and analyze the relationships among them. The income statement reports revenue and expenses of the year. Revenues and expenses are reported only on the income statement. The income statement reports net income if total revenues exceed total expenses. If expenses exceed revenues, then there is a net loss. The statement of retained earnings opens with the beginning retained earnings balance. So the closing or ending balance of the prior year is the opening or beginning balance of the current year. We then add net income or subtract net loss, and these amounts come right off of our income statement. We then subtract dividends if dividends are declared and paid by the board of directors. And what we end up with then is the reported ending retained earnings balance. The balance sheet reports assets, liabilities, and stockholders' equity at the end of the year. Only the balance sheet reports assets and liabilities. The balance sheet reports that assets equal the sum of liabilities plus owner's equity. This balancing feature also follows the accounting equation and gives the balance sheet its name. It reports retained earnings also, which comes from the statement of retained earnings. And then finally, we get to the statement of cash flows. This statement reports cash flows from operating, investing, and financing activities. Each category results in net cash provided, an increase, or net cash used, a decrease. It reports whether cash increased or decreased during the year. The statement shows the ending cash balance as reported on the balance sheet. So we can see each of these statements can be related to one another in that the statement of cash flows reflects the cash that's on the balance sheet. the net income off of the income statement is reflected as an increase or decrease in the retained earnings on the balance sheet. Statement of retained earnings also goes back to the balance sheet, since the retained earnings balance reported in the stockholders' equity section should also be the same as the ending retained earnings balance reported on the statement of retained earnings. So they're very interconnected with one another. And so here we see the net income off of the income statement and how it rolls into the statement of retained earnings. Had this been a net loss, then it would have rolled in as a reduction to the beginning retained earnings balance on the statement of retained earnings. Here we see the ending retained earnings balance from the statement of retained earnings flows to the stockholders' equity section of the balance sheet. Here we see that the cash balance in the assets section of the balance sheet matches the ending cash balance in the statement of cash flows. And so again, we simply are making the point with these slides that these financial statements are interconnected with one another. And in fact, in the audit report that's generated at the end of the year on these financial statements, the audit report says that the financial statements taken as a whole, and that's an important phrase, taken as a whole, shows how interconnected they are. That it's not just one statement individually that fairly represent the results of activities. It's all of the statements taken as a whole together fairly reflecting the results of activities. And so finally, this table provides questions financial statement users often ask about companies and indicate where in the financial statements the users may be found. So someone may say, can the company sell its products or services? Well, we'll look to the income statement to see sales revenue to tell whether that's increasing or decreasing and what trends we see there. We might say, well, can the company pay its liabilities? Well, for that, we would compare assets to liabilities, because assets or cash become the basis for which liabilities are paid. And we'll talk about this whole idea of comparison and ratios later in the semester too. But the ratios and the information and the ability to answer these questions come from our financial statement. And so finally, we want to talk about the concept of ethics and how our business decisions and how we can evaluate our business decisions within a framework of ethical decision making. The importance of ethics cannot be overstated. Good business requires decision making, which in turn requires the exercise of good judgment both at the individual and corporate levels. But what are the factors that influence business and accounting decisions, and how should these factors be weighed? Generally, three factors influence business and accounting decisions: economic, legal, and ethical. The economic factor states that the decision being made should maximize the economic benefits to the decision maker. Based on economic theory, every rational person faced with a decision would choose the course of action that maximizes his or her own welfare without regard to how that decision impacts others. In summary, the combined outcome of each person acting in his or her own self-interest will maximize the benefits to society as a whole. The legal factor is based on the proposition that free societies are governed by laws. Laws are written to provide clarity and to prevent abuse of the rights of individuals or society. Democratically enacted laws both contain and express society's collective moral standards. Legal analysis involves applying the relevant laws to each decision and then choosing the action that complies with those laws. A complicating factor for a global business may be that what is legal in one country might not be legal in another. In that case, it is usually best to abide by the laws of the most restrictive country. The ethical factor recognizes that while certain actions might be both economically profitable and legal, they may still not be right. Therefore, most companies and many individuals have established standards for themselves to enforce a higher level of conduct than that imposed by law. These standards govern how we treat each other and the way we restrain our selfish desires. This behavior and its underlying beliefs are the essence of ethics. And again, I can't stress to students how important ethics is. We're becoming a much more transparent society, and there are a lot of considerations that are being weighed by investors and users of financial statements beyond the economic or the legal consequences of a decision, and a lot of them are based on social or ethical considerations. So we must keep this idea of ethics in mind. And so weighing tough ethical judgments in business and accounting requires a decision framework. One way to think about this would be to think of your decision with regard to these 4 questions as a way of working through what a good decision would be. And so that concludes Chapter 1. It's important that we read the text, go back and read the text, because I pull out just the key points that are in the text. So it's important to go back and read the text, and then please go into the practical section as well and work on the learning exercises, which is a series of multiple choice questions that are meant to reinforce the reading. And then finally, go into the discussion forums, and please be sure to respond to the questions in the discussion forum, because these are all a part of our grade. So please be sure to respond to those, and please be engaged also in the responses you see by fellow class participants, and respond to and react to their comments as well. Thank you very much, and look forward to talking with you as we go into Chapter 2.